Alright, so in this video we're going to talk about the business owner's greatest enemy is their own accountant, tax write-offs. So you see it all the time, business owners turn over some money and what do? They buy a G-Wagon. Because why would you want to pay tax? Yeah? This is a big one because the general goal for a business owner is pay as little tax as possible. So their accountant is incentivized to reduce the tax bill. But what a wise business owner should do is they only use the tax write-off for its actual purpose. Instead of buying a G-Wagon just to pay less tax, they only buy things that actually benefit the business. Because let's look at it. This is the spreadsheet. We're going to pull up the spreadsheet. The spreadsheet never lies. So I'm going to zoom in. So let's use this as an example. Okay, we've got a business owner here. Gross revenue, say $1 million a year, £1 million a year. Pre-tax profit is about 15%. It's a good net margin. And they want to write off 100 grand. So the CPA or the accountant says, listen, you've got 150 grand in profit. So instead of giving that to the IRS or HMRC, we want to spend that money. We just blow the money on something for the sake of it. So we'll buy a G-Wagon because it's a tax write-off. And this is a trap. Okay, this is a trap. When you see the math, you'll start to realise. So this is how they justify it. But what they don't realise is the less profit also means the business cannot be sold for as much as someone who kept retained earnings. So a sovereign strategist would actually keep the business profitable and pay the tax because they realise tax is the toll for success. There are legit ways to reduce the tax, but just buying a G-Wagon, which depreciates year after year, is the most stupid idea for a business owner. So 100k chuck, a G-Wagon, depreciates 15 to 20% a year. By year 3, it's worth 58 grand. So you spent 100 grand to own something worth 58 to save 30 grand in tax. So net position minus 12 grand. That's before the running costs or expenses. But the accountant will say, well done, we spent 100 grand to save 30 grand. Of course, yeah, so sophisticated buyers do add back one-time items. So a buyer that's going to buy the business yes, you can add back depreciation. But if it's a consistent write-off pattern, it tells the buyer you're just an operator and they price this into the multiple. The point is, business owners are really trapping themselves in the business. And the same applies for even small businesses that they don't necessarily have the money to buy a G-Wagon. But 2 days ago, I spoke to a joiner who was 67 and was still working. He had absolutely no pension. He had no retirement because he likely, even worse, just lived off cash, physical cash, which you cannot invest. You can't invest cash into the markets. It depreciates year over year. So you're actually just trapping yourself in a business which needs 100% of your attention and time and effort. And you're trapping yourself in a hamster wheel year after year. And this is what most business owners do. They're trapped in the grind forever. They can't escape. Because the accountant is trying to help them reduce the tax bill rather than actually build a legitimate business that can be sold. So it gets worse. Right? Look at this example. So say he buys a G-Wagon. So the civilian investor buys the G-Wagon. Let's imagine January rolls round, the business has a slow month, cash is tight. So the owner only has 35 grand instead of 105 grand, which the smart business owner has. And a genuine business opportunity shows up. Something that would generate the business significant return on investment. And the person that bought the G-Wagon, the business does not have the cash to do it. So they need to borrow money. So think about this. They've actually borrowed money. 70 grand could be borrowed at 10%. They're paying 7,000 in annual interest. Over 3 years, that's 21k in interest. So the 30 grand ends up costing hundreds of thousands because the actual value of the businesses went down, because the net profit's smaller, and they have borrowed money, which further puts a debt spiral on the business. So the actual tax write-off has actually forced the owner potentially into debt and reduced the actual value of the business if they were to sell it. But of course, the business owner wants to look successful, so they have to drive the G-Wagon. Look, it's a lovely car, but there's different ways to buy it. There's smart, intelligent ways that you can do it. But first, you've got to invest in yourself, actual real assets. So let's look at the alternative option, right? So the civilian business owner has destroyed 370 grand of pure business valuation because they've kept that net income so low year after year. They've not retained any cash, and the profits have stayed low, and they've got depreciating assets. Versus the sovereign business owner who actually grows the cash and invests the cash. Over a 10-year period, they're compounding the cash to 875,000. Say, for example, they've invested it in the NASDAQ. They're compounding the value rather than buying depreciating assets. The math is brutal. It's absolutely brutal. So the guy that saved 30 grand on the tax bill lost out on a potential 720,000. This is the crazy thing, but an accountant is not a strategist. They're not a capital allocator. They're not an investor. They simply look at the last 12 months and they're incentivized to reduce the tax. They don't look at the bigger picture. They are not a capital allocator. They are not an investor. They just say, yeah, buy the G-Wagon, man. Just buy the G-Wagon. And this is often how business owners justify it to people that are like employed. They say, well, you don't understand because you're an employee and we're using tax write-offs. Yeah, so whatever way you spin it, it's not the sensible option. The tax write-off should be used for its actual intended purpose. Say you want to buy, a construction company wants to buy an excavator. That's the whole point of the tax write-off, right? So they buy an excavator because that excavator generates actual cash. The G-Wagon doesn't generate any cash. It doesn't create any yield or any cash for the business. So an actual item that's designed to grow the business is different. That's what it's actually for. But you can see here the bigger picture when you actually zoom out and you see the combination of losing liquidity, no cash in the business, also no money for capital expenditure as well, because leaving the civilian business owner has 35k left over. That's not even enough money for capital expenditure to build the business up even more. So these are other aspects that people are not looking at. It's something people definitely don't look at, especially business owners. They don't take time to sit quietly and think about these things because they just simply trust their accountant. They think, well, the accountant knows what they're doing. The CPA knows what they're doing. And it's not true. I personally was not impressed. Any accountants that I've dealt with, I've never been impressed by them. Sorry to say, but I'm sure there's some great accountants out there. But they are incentivized to just reduce the tax bill. They're not looking at the strategy. So if your accountant is telling you to buy a G-Wagon to pay less tax, think twice about it.